Yeah,
Grand
I was
Rising.
there.
Yeah, good to see you. And Sister
Yeah,
Constance as well. Welcome back. Welcome back. Good to see you again as well. Do you know what I'm
Thank you.
saying? Good to have you. Yeah, good to have you. Today's a good one. Today we're going to be doing tips and risk management. We're going to do risk management today because that's what I promised last week. So I'm really looking forward to today's session. How are you? How was your week?
Fine, it was good, but
Yeah.
I didn't do your assignment.
All right. Fair enough. Well, you've got another week now. You've got,
Yeah,
there's
it was
always
so
time,
busy.
man.
Yeah, it was so busy, so I didn't time. Last night I tried, but I was sleeping on the on the video, so I went to bed. So,
I hear you. I understand that. No, for me, it's been a long week as well. So I've really had to kind of juggle to stay on top of this week. This week has been, I've been losing stuff left, right, and center. I've been struggling to make time, but we've made time. We're here. I'm glad that we're here early. I mean, this
I
is
appreciate you doing this today, bro.
yeah, love, man. This is definitely not a regular thing because normally, because of the nature of what I do for work, like I'm a creative, so I'm normally out late, especially on weekends. Like performing at events or doing stuff. So when it comes to the morning, I'm sleeping. These are talking about being up at 6, and I'm clapping for you. Do you know what I mean? I'm respecting it. I'm rating it. I love to see it. And sometimes I do it, but not as in I wouldn't make a habit out of it. Because I know that I stay up late for work. I stay at like 3 in the morning and I'm getting home. Why am I waking up at 6? Doesn't make sense. Do you know what I mean?
Bro, if I weren't doing this 75-day training thing, best believe I would not be up at 6.
I hear you, bro. I hear you. But you know what I'm saying? We do have to you have to do what you have to do. Do you know what I mean? What we have to do is get this money in. So discipline is important. And that's why we're here, right? So shout out to every single one of you that is here. It's 11:11, so we're going to get started. Shout out to everyone that's here. I'm grateful for you guys that have come through. I'm appreciative of you guys. I'm hoping you guys do walk away with some value and some benefit today. I'm sure you will. Today's one of my favorite sessions, Pips and Risk Management. It's actually the first session that I put together. The first Sunday study session I ever did was on Pips and Risk Management. So I feel like it's so important. And when I did it the first time, I feel like it might have gone over some heads because we didn't have the routine, or we hadn't done the candlesticks, we hadn't done the this, we hadn't done the that. Do you know what I mean? So now I feel like everyone's kind of got a build up. This Pips and Risk Management study is going to make a lot more sense to people. That's what I'm going for. That's the plan. So we're going to dive in. Thank you, Prima. Thank you. And we love you too. I'm telling you now, man. We appreciate you. I'm grateful for your spirit. I'm grateful for your existence. I'm grateful for every message you post in the chat, in the Telegram group and in the Zoom chat. I'm grateful. I'm great. Every time I see your face, I smile. I'm like, yes, Prima. You know what I mean? So we love to see it, man. Okay, cool. All right. So Pips and Risk Management. In fact, before we get started, because I'm forgetting this is a recording, so some people might be watching this back after the fact, I should introduce myself and how this Sunday study session came to be briefly. So my name is Nate, as you can see, somewhere at the bottom. I'm a poet. I run events. That's what I do for work. Lockdown obviously slowed me down a lot. Until my brother Justin, he's on the top of my screen right now. You know what I mean? With all the money in the background. Until my brother Justin came and put me into this space, for which I am forever grateful. I'm so grateful because this helps me to develop an extra stream of income. Admittedly, it wasn't like I wasn't balling. It wasn't like I jumped in and I was like, okay. And then all of a sudden, money starts falling out of my phone. Well, I mean, money did start falling out of my phone, actually. But, not to the degree that I had initially anticipated, right? And I think that's because I didn't understand when I started that this is a marathon. This is not something where you just jump in and all of a sudden you're a millionaire. This is something where you take time, you develop a skill, and you will make money for the rest of your life, simply from knowing this skill set, right? Which I love, So I am studying this skill sort of everything I've got because I will be on the other side of this percentage, this success percentage. I'm going to be on the other side of it. That's a fact. I'm not going to be one of those traders who's here just losing all my money and then giving up. That's not my story. So, thank you to Justin for putting me onto this space. But when I was here, obviously I'm paying for the same thing you guys are paying for. I'm paying for Shift, I'm paying for Mind Hub, I'm paying for Wow. And Wow was great, but at first I didn't really get it. And then we had a sort of like a study session. It wasn't a Sunday study session, it was just a study session with the King Carl Collins, who, literally bust it open for me, made it make so much sense. He made it make sense to me in a way that's never made sense before, just by explaining, I don't even remember what the subject was, do you know what I mean? But just by explaining candlesticks or whatever it was, it was like, oh, okay. And then suddenly I really got it. And then all the videos I watched on Wow consequently, after that, made a world more sense, So the only thing that I felt was missing was the consistency, which is why I decided to introduce Sunday study sessions. This is my way of giving back, of my way of saying thank you. I'm not being paid to do this. I've not been asked to do this. This is my choice, which is why, Emmanuel, do you know what I mean? I get to eat on camera because, I get to run the thing how I run it. So, Sunday study sessions is casual. I really do invite your participation. I want you guys to talk. I want you guys to communicate. Do you know what I mean? Use the chat. It pops up on my screen. I can see it. Yeah. Use the chat. Let me know what you guys are thinking. If you guys have questions, chime in and interrupt. Be like, sorry, Nate, I have a question. Can you give me a second? If I'm in the middle of something, I'll be like, hold on, let me just land. Or can you guys hear me? So I just had a phone call come through. Yeah, okay,
yeah, just froze for a sec.
Yeah, I had a phone call come through. I just had to lock that off. Thanks, guys. Okay, all right. So let's get started then with the with the conversation. So in order to understand risk management, which is going to be our focus for today, I need you guys to understand what a pip is. Yeah, I'm going to share my screen. I'm sure some of you guys already know. I didn't see any first timers in the when I was scrolling through. Let me see if anyone else has joined actually. Oh, I had a couple more joiners. Are any of you guys in here first timers? I don't think Joan is a name that I recognize. I don't think I've seen you here before, Joan. Anybody here first timer? No? Okay, excellent. All right, in which case, this should be easy then. Brilliant. Let me just share my screen. Let me know, confirm you guys can see my screen. Can you see my screen all right?
Yeah.
Lovely. All right, brilliant. Okay, so this is the screen that we get when we first open the MetaTrader 4 app. You also see this screen on any trading platform, really, TradingView, whatever it is you decide to use, you'll see this in front of you. These are our currency pairs. I'm sure by now most of us know what the currency pairs are. But just for those of you who want a refresher, or those of you who are watching this video back, currencies are always measured in pairs. On the left-hand side, you've got the base currency. On the right-hand side, you've got the quote currency. The base currency is always worth one of itself. So for example, using the illustration, the example at the top, Euro GBP, the euro being the base currency is worth one. So €1. And the quote currency is the question, what is it worth? Can you show me the quote? Yeah, so €1 is worth how many Great British pounds? And the answer's on the right-hand side, £0, 85 pence. Below that, €1 is worth how many US dollars? The answer's on the right, $1, 17 cents. And then below that, £1 is worth how many US dollars? Yeah, $1.37 cents. So we can see that one is the base, €1, £1, £1 Australian dollar, $1 Canadian dollar is worth how many on the right-hand side is the quote. And then you got the answers there. Now, as you can see with the answers on the right, they are broken down into 6 digits. 1.37270. 1.23456 digits. Yeah, on both sides. It doesn't matter whether you're looking at the low or the high, it's the same difference. Okay, they are broken down into 6 digits. Those 6 digits come with names. Hold on. We go this way. Boom. Those 6 digits. So we got 1, 2, 3, 4, 5, 6. There's our decimal point. 1 point. Yada 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 yada. So this one at the very end is called a. Oh, my phone knew. It's called a pipette. This one at the very end is called a pipette. Now, the pipette is such a small number that we don't really tend to give it much play. Yeah, we don't really give it much. We don't really give it much attention unless you're trading NFX, in which case I haven't tried trading NFX yet, all now, but I know that NFX is a lot faster, and I'm pretty sure that what we're measuring on NFX is the pipette. If that's the case, then that's something that you guys want to study separately. But for standard or normal Forex trading, we don't really business with a pipette, okay? The pipette is so small, as you can see here, the pipette is the tiniest number, okay? So we don't really give it too much attention. The pipette needs to go up 10 digits before it affects the next number along, okay? So for example, this one here is on 0, right? So it will go 1, 2, 3, 4, 5, 6, 7, 8, 9. And then this 7 will then go up to an 8. And this will be 0 again. 1, 2, 3, 4, 5, 6, 7, 8, 9. And then the 8 will now go to a 9. Okay, so it takes 10 pipettes to make one of these. What are these? Well, this one here is called the pip. So what is a pip? A pip is a unit of measurement. Okay, a pip is a unit of measurement. So the example that I usually give is, you know, if you're training, if you go for a run, for example, you can say I ran for 5 miles today, right? Or I rode my bike for 10 miles this week, or, you know, whatever. Another example, because I drink a lot of water, you can say I've drunk 2 liters of water today. If the market is moving, then we can say the market has moved 100 pips today. Okay, a pip is a unit of measurement. So if we're going to ignore the pipette, hold on, let me do that in red. There we go. If we're going to ignore the pipette, then we've got our units, we've got our tens, we've got our hundreds, we've got our thousands. Okay. So if a pip is a unit of measurement, a unit, and this is the 1 pip, remember? Yeah, is the 1 pip, and a pip is a unit of measurement. Then if the market goes from 1.2000 and whatever the pipette is to 1.2001 and whatever the pipette is, okay, then the market has moved 1 pip. Is that making sense to everyone? Is everyone seeing that?
Yeah.
Yeah, simple enough, right?
Yeah, okay.
Lovely. I'm presuming that most of you guys kind of know this, so I'm trying not to dwell in it too much, so that we can get to the risk management section. But it's important that you understand what a pip is, you know what I mean? So that we know what we're looking at. So, okay, if the market goes from 1.20007 to 1.250, then the market has moved. This is the units, this is the tens. So the market has now moved 50 pips. Yeah. And if the market goes from 1.2000 to 1.2, say 100, the market's moved 100 pips or 105 pips. Okay. Or 172 pips. Okay, the market has moved from A to B. So looking at where the market is right now, let's pick an example. And let's say, is there an easy one? It doesn't look like there's a particularly easy one. Let's scroll down and see if we can get one that looks kind of easy. Okay, here we go. All right, so let's say this market goes from 1.09308 to 1.09508. The market has moved 20 pips, yeah, because it's gone from 30 up to 40 up to 50 pips, right? So it's gone up 20 pips. If it goes from 1.09308 down to 1.07308, then the market has gone down 200 pips. Okay, so the market's gone down 200 pips because the hundreds section has moved. In order for it to go down to 1.07, it would have to go from 30 to 29 to 28 to 27 to 26 to 25 to 24, all the way down. Yeah, 200 pips. The pip is the unit of measurement. Is there anyone that's not making sense to, or has everyone got that clearly?
Yes, it is. It is making sense.
Mm-hmm. Lovely. Okay, brilliant. All right. So I like to stick with GBP USD for the sake of these. Oh, I've left my thing on. For the sake of these study sessions, I like to stick with GU for the sake of these study sessions because I feel as though I don't know. I just feel like it's probably one of the easiest ones to read. So as we can see on the right-hand side, that is current price in the blue, 1.37273. 1.37273. Let me just highlight that right there. There you go. So the 3 on the far right-hand side is the pipette. We're going to ignore the pipette. And the market is currently at 1.3727. So if it goes to 1.3728, it has gone up 1 pip. And if it goes to 1.3726, it has gone down 1 pip. Looking at this more literally, what does that mean? Well, it means that right now, because this is the chart for pound dollar, remember, £1 is worth $1.37. Okay, you can actually see as well, because this is the monthly chart we're looking at. We're not going to discuss time frames today, but this is the monthly chart we're looking at. So you can actually see that back in the day, £1 was worth $2. Over here, £1 was worth $1.69. Down here, £1 was worth $1.19. Currently, £1 is worth $1.37. Okay, so the market is moving in pips. That is what a pip is. Excellent. A brief cover on market structure, because we did market structure last week. Who remembers market structure last week?
Yeah.
I did.
Yeah? Yeah, lovely. We've got a couple people that were here last week. Okay, good. All right. A brief cover on market structure. What is it? So the market has certain levels that it will respect. These levels are support and resistance levels. So you can see here, for example, the market's coming down. It bounces off of this level and goes up. The market's coming up. It bounces off of the same level and drops down. Yeah, this level, this pricing level here, which could be considered support, could also be considered resistance. Okay, but this is a level that the market clearly respects. Whenever the market comes into contact with this level, it respects this level. Right? Not whenever, because as you can see, it has broken through right here, but most of the time. Got another example right here, good example. Every time the market comes into contact with this area, it bounces off of it. Every time the market comes into contact with this area, it bounces off of it. Every time the market comes into contact with this area, it bounces off of it. That is the essence of market structure, okay? if you can look back at historical data and get an idea of the levels that the market is likely to respect, that will help you to plan your trades going forward. If you want more information on market structure, then you can either A, as I said, you can check out the videos on WoW, or you can B, check out our video from last week. Okay, because last week we did a study session on market structure for those of you who weren't present. Market structure exists on all different time frames. So if we were to zoom into the hour 4, which is where I like to place my trades, okay, I feel like now we will have like a general understanding of what it is we're looking at here. This should all be quite clear to everyone. We can see what the price is. You know, the price hasn't changed, 1.37273. It's just now the only difference is we're looking at the hour 4 time frame as opposed to the monthly time frame. And again, if you want more understanding on time frames, then we've also got a study session on that. You know what I mean? So there's a lot of homework to be done, but this wasn't anyone's first session. So if you're watching this back later on, then I'd recommend that you check out some of the others as well before this, I guess. So if you're looking at market structure and you're using market structure to plan your trade, okay, how would you go about managing your risk? Well, let's say, for example, you're looking back and you can see that the market has respected this level, it's respected this level, it's respected this level, it's respected this level, and it's currently on its way back up, right? And you're thinking, as soon as it gets to this level, I am going to press sell. Because I believe that when it gets here, obviously we can see that this has already happened now, but let's just pretend that this doesn't exist, right? So you're like, as soon as it gets back up and hits this level, I'm going to press sell. Now it hits this level and you press sell, and obviously your trade would have been correct, right? But where would you have placed your stop loss? Where would you have placed your stop loss? So as a general rule of thumb, what I would suggest is that you go back to the previous other level of support or resistance, depending on whether you're doing a buy or a sell, and you place your stop loss just above that. Why would I say that? Well, if you enter the market here and you put your stop loss here, then as you can see, that's a bit risky. But if you were to say, okay, look, the market's come up here and respected this level, then I know this is where I think the market is going to come down. But if the market does continue to go up, this is the other level that the market has respected. Yeah, so right now, the market's respecting this level, it's respecting this level. I'm expecting it to respect this level again. However, just in case it doesn't, right, I'm going to put a seatbelt, my stop loss. And I would put my stop loss probably just above the previous level, like another level of resistance, so that the market would have to break through this level and break through this level in order for me to lose my trade. If the market breaks through 2 levels of resistance or support, then fair enough, I made a bad call. It's okay. It's not the end of the world. Or is it? Or is it the end of the world? Well, that depends on my lot size. So risk management is a mixture of 2 things. One of them is where you place your stop loss. The other one is your lot size. So as you can see, where you place your stop loss should be dictated by the market. Where you place your stop loss, it should be dictated by the market. It's not a case of, okay, I'm going to enter here, I'm going to put my stop loss here because I want to. That will lose you a trade, okay? It should be dictated by the market. So you should be thinking, okay, look, this is where the market is. If I enter here, oh, that was meant to happen. Here we go. If I enter here, then I'm going to put my stop loss next to this previous level or next to this previous level even, yeah, of resistance. So that I know, as I said, if the market does break up, it would need to break through a few levels before it hits my stop loss and loses the trade. That's what you want. You don't want it to make it easy for the market to come and take your money. Yeah, you want to make it as difficult as possible for the market to take your money. the market should have to break through maybe 2 levels of support or resistance before it can take your money. And if it breaks through 2 levels of support or resistance, then the trade was wrong. It's fine. Take time, take a step back, take a breather, and check it out again later, right? But that's really what you want to be doing. Same going for the downside. Let's see if we can find an example on going the other way. Here we go. Perfect. Was that perfect? Yeah, actually, this is perfect. Okay, so let's say we are here. Let's say we're here. This is the point of interest. Okay, so we are right now. We are like there. Okay, we're there. Excellent. So I can see that the market has, okay, I'm going to move forward because I don't want to do it later, but you remember where we are, yeah? We are right there. Cool. All right, so I can see that the market has come down to this level, respected it, and bounced. It's come down again, respected it, and bounced. Then it's broken through, and it's hit this level down here. Then it's bounced, right? Now it's coming back down. Now let's just say, for argument's sake, that this was my trade. I was like, right, I think this level here, we're going to hit this level, and we're going to go up all the way to the moon, right? That's what I think is going to happen. So I enter the trade here, and I press buy. Where should my stop loss be? Now, I might turn around and think, okay, because I've entered here, my stop loss is going to be down here below this teeny little level of resistance, as you can see, of support, sorry. As you can see, that would have lost me the trade. However, if I put my stop loss below the next major level of support, then you can see that the market would have come down. It would not have touched my stop loss, and then it would have carried on. In this instance, okay, in this instance, there's nothing to say that's always going to happen, but in this instance, my trade would have been safe. And then what would have happened? Well, we would have gone up to take a bit of a profit, and then maybe that would have been a good time to exit the trade, I guess, you know what I'm saying? Because it would have been a bit of a, but we would have made some money, right, on this trade. We wouldn't have lost money. That's what's important. That's what the stop loss is about. We wouldn't have lost money, right? So, as I said, as you can see, where your stop loss is located should be dictated by the market. It's not really a choice that you get to make, okay? Another example would be on shift. So shift might turn around and say, okay, there's a trade here, enter at XYZ, and I'm going to need you to have a 50 pip stop loss. That's what DMC might say. Enter at XYZ, and I'm going to need you to have a 50 pip stop loss. That's not a choice you get to make. You don't get to make that choice, okay? Or Fred might say, enter gold here, and I want you to have a 30 pip stop loss. 30 pips, that's not a choice you get to make, okay? That's a choice that's dictated by the market. That's why Fred has said it. That's why, because Fred is saying, okay, look, this is the next major level. This is where we've entered. This is our 30 pips or whatever. Out of curiosity, how many pips is this in this instance? Let's have a quick look. Let's see if we can do some quick math. I don't want to, go too much into it, but that was the plan for today. So at the bottom here is 1.35990. So we could call this 1.36. And then up here is 1.3727. So we can call that 1.37, let's say 1.373, just for the sake of math, yeah? So from 1.36 to 1.37 is 100 pips. Yeah, that is 100 pips between 1.36 and 1.37. Okay, so if you've got a 100 pip stop loss, now, like me, you may decide, do you know what? I don't fancy entering a trade with a 100 pip stop loss. And that's fine. You don't have to do that. You don't have to enter every single trade just because. If you see a trade that has a 100 pip stop loss, you might decide you don't want to enter it. Or you might decide you want to enter it, whatever. right? Let's have a look at this next one. Yeah, we're in animation. Good. Okay. So this is where we entered right here. And this was where our stop loss was going to be. Is that right? What is that? That's 1.3885 to 1.3995. So that's another 100 pips, 110 pips. Yeah, is this making sense to everyone? Is everyone following me? Can you still hear me? Just checking in.
Yeah,
loud and clear.
Yeah. Okay, lovely, lovely, lovely.
Yes.
Thanks, guys. Okay, so let's say you've got a 100 pip stop loss. Okay. The next thing, the next factor in your risk management strategy is going to be your lot size. So what is your lot size? Well, your lot size is how much money you are willing to risk, or how much money you're going to enter into the trade, how much money you're going to invest into the trade. Okay, what you're doing is you're buying shares in the market. You're buying a slice of, the value of this thing, and your lot size is how many shares you're going to buy, right? So if, for example, as I said, we enter a market at £1 per pip. Let's just keep it simple. We enter a market at £1 per pip. Okay, if the trade goes the right way, you are going to win at a rate of £1 per pip. If the trade goes the wrong way, you are going to lose at a rate of £1 per pip. Okay, because you have entered the market at £1 per pip. You've entered at £1 per pip, right? So you're either going to win or you're going to lose at a rate of £1 per pip. Now, if your stop loss is 100 pips and you lose the trade, that means that you will lose £100. It's going to be completely up to you whether you can afford that or not. Me, with 150 quid in my account, no thank you. Do you know what I mean? I'm not trying to lose £100 in one trade. I'm not trying to lose £100 in one trade. Okay. You might have, I don't know, 20 grand in your account, 100 quid. Let's give it a shot, see what happens. Because if you win the trade, yeah, then you should be able to win more than £100. Let's see if you had won this trade. Let's have a look. Let's say we're down here. So we've gone from 1.3885 to 1.3727. So 88 to 77 would be 100, to 72 would be 150 pips. So far, you're up 150 pips on this trade. So far, you're up 150 pips on this trade. Your risk was 100 pips. Your reward so far is 150. You might want to wait until it gets all the way down here. So that'll be 250. Do you know what I mean? That'll be great. But you can see that your risk and your reward ratio is worth it for you. Yeah, because your risk is 100, your reward is 250. Yeah, that is a fair risk to reward ratio, I think. But that's a decision you get to make, right? Because you look at this and you say, okay, this is what I'm willing to risk. This is how much I'm hoping to earn. And risk management, I would strongly recommend that you pay as much attention to the risk as you do to the reward. Because if you enter a trade thinking, and this is one of the most common slip-ups in my opinion. This is one of the most common slip-ups in my opinion. If you enter a trade and you're thinking, if I enter this trade at £1 a pip, I am going to earn £250. If I enter this trade at, £2 a pip, I am going to earn £500 or whatever. If you're thinking like that, right? If you're thinking like that, you're thinking more of the reward than you are of the risk. It might be great for the trades that you win, but it will be horrible for the trades that you lose. Okay, I would strongly recommend, because the location of your stop loss is dictated by the market. Yeah, that's not something you get to choose. So I would recommend that you choose your lot size based on how much you are willing to lose for each trade. Yeah, based on how much you're willing to risk. Sorry. That's a better word that I should use. How much you're willing, because you're not willing to lose anything. Do you know what I mean? How much you're willing to risk. Okay. So as I said, I wouldn't be willing to risk 100 quid. I would probably, if I saw a trade that had a 100 pip stop loss, I'd probably enter at 10 pence per pip, because 10 pence per pip means if I lose this trade, then I lose £10. If I win this trade, I win 25. Okay, that would be great. It will take a couple of weeks by the looks of things, 1 week, say 2 weeks maybe, for me to earn this £25. It's going to take time, it's going to be long, but at the end of the day, it's a skill set that I'm learning. I need to work, get my money up, or do network marketing. Get your money up, do you know what I mean? And invest more money. You know, like the more money you're able to invest, the more you'll be able to pull out of this space. But really and truly, it's about learning the skill. That's what's important, you know, knowing how to do it. Because once you know how to do it, whenever you get money in your life, wherever you get money from in life, you can invest that money. Yeah. So the first thing, what you want to do right now, while you are in this space today, is you want to learn. Yeah. You want to learn. You want to lose money. You want to just try it. Just try stuff. Just always manage your risk. Never risk more than you can afford to lose. And then shoot your shot, man. Just give it a shot. Just try it. Do you know what I mean? And learn and learn and learn and learn and learn. Money is energy. You will always have more money. There will always be more money. Don't worry about it. Do you know what I mean? Like, okay, if you've got responsibilities, then you definitely must prioritize them. Don't let your children starve so that you can trade, because that's not the way, you know. But there will always be money, guys. Money is not going to disappear. And if it does, then you don't need to know how to trade, because there's no money. What's the point, right? So for as long as money exists, this market is not going anywhere, right? Take your time with it, respect the market. Remember that it takes people years to learn how to do this efficiently. Okay, it takes people years to learn how to do this efficiently. There are professionals, there are people who are paid to do this for other people even, you know? So please don't just think, you know, you're gonna jump in and all of a sudden you're gonna be a master trader like I thought when I first started, because I picked it up pretty quickly. I was like, oh, I'm really good at this and yada, yada, yada. It's not a quick thing. You know, it is something that is going to take time. It's going to test your spirit. You're going to learn discipline. You're going to learn patience. You're going to learn to not be greedy. You're going to learn so many different things about yourself while you're on this journey. Just be patient. We spoke about patience the other week as well. Just be patient, you know, and take time with your journey and respect the journey. And in time, you will definitely get it. Okay. But right now, what I would say is it's about learning. And while you are learning, or even while you're not learning, even once you're a pro, you know, you will do this naturally. But while you're learning, one of the things that you must learn is to manage your risk. One of the things you must learn is to manage your risk. Okay. So there's this game that I play on my iPad called 8-Ball Pool. I don't know if any of you guys have ever played 8-Ball Pool. 8-Ball Pool is really good, man. It's a really, really good game. So it's like snooker, but pool, you know, pool, right? And you're playing it on your iPad, so you know you kind of like draw the cue back and then pot the balls and whatever. And you're playing online with like an online community. And you're winning money as you're playing the game. You're winning money, not real money. Obviously, it's in-game money, yeah. And it's got like a kind of casino feel to it. It's a really good game. I'm proper like, you know, I play it a lot. The money management on that game is very similar to trading. That's one of the reasons why I like it so much, because the money management, the way the money management is set up is very, very similar. You can start off with 0. You play your first game, you earn 100 coins. You play another game, you earn 100 coins. You play another game, you lose 100 coins. You play another game, you earn 100 coins, you know, so on and so forth, until, you know, you say you've got like 1,000 coins. And then what do? So there are more expensive games available. You can now play a game which is worth 1,000 coins per game, but you only have 1,000 coins. So are you going to risk 1,000 coins on one game, or are you going to keep on playing 100 coins, 100 coins, 100 until you finally have 2,000 coins? Or are you just going to risk it all? Do you know what I mean? And try and get your 1,000 coins in one shot. It's not real money. Give it a shot. Lose your money and start from the beginning. Do you know what I mean? That happens. It If it was real money, you might want to take it a bit more seriously. But you know, for the sake of the game, I've tried all sorts of stuff, man. You know, so you're playing now. Let's say you do it. Let's say you shoot your shot and you get your 1,000 coins. Boom, excellent. Yeah, now you got 2,000 coins. Then you play again in the 1,000 coins per game section. Boom, now you got 3,000 coins. Look at you on a roll. Then you play again in the 1,000 coins per game section and you lose again. Boom, you're back down to 2,000. That's the way the cookie crumbles. That's the way the game is played, right? You play again, you play again, you play again. Now you've got 10,000 coins, right? Now there is a section where you can play 10,000 coins per game. What are you going to do? Are you going to play 1,000 coins until you've got another 10,000? Or are you just going to risk it all and play 10,000 coins per game? Let's say you do that and you blow your account and you're back at zero. You are fuming. You are fuming. You had 10,000 coins and now you're back to zero because you risked all of it in one game and it's gone. Yeah, someone came and they potted the 9 ball on the break and that's it. You didn't even get a shot and now you've lost everything, right? That happens very often, okay? That is an illustration to explain why it's so important to manage your risk because you never know what's going to happen. Yeah, in this game, 8-ball pool, someone can win the game on the break. That is, those are the official rules of pool, yeah, of 9-ball pool actually specifically. You can win the game on the break. You put the thing, and the 9-ball goes in. That's it. They're taking your money. Game over. You didn't even look. You didn't even get to do anything. You just logged in, and then the money's gone. Done. Yeah. That is something that can happen in trading as well. The market is so volatile. You can enter a trade, and then all of a sudden, the market goes up, hits your stop loss, and that's the end of your game. That's it, right? And that happens. That's fine. But how painful would that be? Look at it two ways. If you had risked 10,000 coins on that game and then you lost it immediately without even, you're going to be vexed. You're going to be punching the wall. You're going to be thinking, I worked so hard to get up to 10,000 coins and now they're all gone. But if you had only risked 100 coins, for example, and you lost that game immediately, you'd be like, wow, that's funny. Look at that. That's crazy. On to the next game. Do you know what I'm saying? You live to fight another day because you haven't risked your entire budget on one game, okay? That is the essence of risk management. That is the essence of risk management. So let's say, for example, you have, like I said, let's say you've got 100 quid in your account. Are you going to risk £1 per pip and risk £100 on one trade? Because if you lose that trade, you lose your entire account. If you win the trade, great, you've just earned 250 quid. That couldn't be better, right? That'd be beautiful. But if you lose the trade, you have lost your entire account. You are playing with fire. Doesn't matter how good a trader you think you are, the market is volatile. Anything can happen. Nobody knows what is going to happen in the market. That is something that I reinforce with my chest. No one knows what's going to happen. Everyone can have a belief. Everyone can have a perception. There can be some extremely educated guesses, right? But if the wealthiest financial players are saying we don't know what's going to happen, then all the more so for us who are in B, you know, who are kind of here learning, we definitely don't know what's going to happen. Yeah, we don't know. There are ways that you can get, you know, insights. I know my sister Salome has been dabbling in the astrology. I know that's something I definitely want to get my head into as well, the financial astrology, because I know that this definitely flows you know, in alignment with the moon cycle and this and that. And there's a lot of ways you can get an edge. You can learn about the actual economy of the country that you're studying. There are a lot of different ways to get an edge. But the fact of the matter is the market is volatile. Okay, so until it happens, I would like to say that I don't think any of us are qualified enough to say, boom, we know what's going to happen. And because of that, it is really important that you don't over leverage. It's really important that you don't risk more than you can afford to lose. It's really important that you manage your risk on every single trade. So if I had entered this trade at £10 a pip, 10 pence a pip, sorry. If I lose £10. If I win 25. Let's say I win my £25. Now I've got £125 in my account, right? Let's say I do that again. Now I've got 150 in my account. Let's say I do it again. Now I've got 175. Now I've got 200. It took me 4 trades to get to 200, whereas I could have done it in one trade. You know, if I had taken a risk and shot my shot and been reckless, I could have done it in one trade. But at the same time, is the risk worth the reward? Is the risk worth the reward? That's the question you need to find out for yourself, right? I can tell you as someone who has blown my account more than twice, that it's really not, man. Do you know what I mean? Like, take time with it. Just be slow. Just be slow. You don't need to rush. Investment is a long game. Investment is a long game. You know, when you invest in, let's say you invest in my company, right? Let's say I start up a company doing X, Y, Z, and you invest £100 or £1,000 in my company. Are you expecting to see a return on your £1,000 immediately? Or are you thinking, right, now Nate's got a lot of work to do. He's going to have to do A, he's going to have to do B, he's going to have to do C. And then in a couple of years' time, once his company has matured and developed, I will see a good return on my investment. A couple of years, guys. You know, it's not like you're going to give me £1,000 and I'm going to say thanks and then give you back two. That doesn't make sense. Do you know what I'm saying? I know the Forex market is very fast, but at the same time, we have to respect that investment is a long game. Investment is not a short game. Okay, so it's really important that you manage your risk, that you take time, and that you prepare yourself mentally to be in this for the long term. Prepare yourself mentally to be in it for the long term. Do you know what I'm saying? And the best way to do that is by catching as many small W's consistently as you can. In my opinion, in my modest opinion, that is the best way to grow your account in this space, because you are managing your risk. Yeah, so you're growing your account slowly, 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 slowly. Any losses that you make is a small loss, period. Any losses you make are the small losses. No big losses, ever. Any loss you make is a small loss. And when I say a small loss, I mean small for you. Because what is a small loss for Nathan Salmon is not a small loss for me. Do you know what I mean? What is a small loss maybe for Emmanuel is not going to be a small loss for me. Do you know what I mean? So me, I don't want to lose too much money on a trade. You know, for me, a small loss is like a fiver or a tenner. For Augustine, a small loss might be 100 quid. He's like, fair enough, I lost 100 quid on this trade. Oh, well, that sucks. On to the next trade. Do you know what I mean? A small loss might be £50. For me, £50 is a big loss. I don't want to lose £50 in one trade. Do you understand? I don't want to lose £50 in one trade. Not yet, not until I've got, say, like a couple of £1,000 in my trading account. Then, even then, £50 is still a lot to lose in one trade, but at the same time, it's calm. I don't mind because I've got a couple thousand. Do you know what I mean? If you're managing your risks and you're taking small losses, then it's about improving your skills and stop losing. Do you know what I mean? Now it's about, okay, let me not just jump into random trades. Let me really, really make sure that I'm confident I'm going to win this trade before I enter the trade. Yeah, so that's the pattern basically. So just as a recap, firstly, risk management is comprised of two elements. One is your stop loss. Your stop loss is dictated by the market, or it is dictated by the traders on shift. If you decide that you only want to risk 10 pips and you choose to put your stop loss here, you will lose, yeah, because the market won't play like that. The stop loss is dictated by the market. You look at the market and say, okay, where was the previous support and resistance levels? All right, cool. Let me give myself a 50 pip stop loss or a 70 pip stop loss or a 100 pip stop loss, right? Let me give myself a 100 pip stop loss or whatever. If you find a better trade than this, good for you. You know, let's say, for example, you entered the market here. You could put your stop loss up here. Then it's not 100 pips. Or let's say you entered the market here and chose to put your stop loss up here. Then it's a lot less. Do you know what I mean? That's a great trade. Look at that. Beautiful. Imagine if it had gone up, it would have hit your stop loss. And to be fair, the chances of it going up from here are quite high because, as you can see, we're zigzagging here a lot, right? So it's possible. But sure, you know, whatever, right? You get the point. If you can have a smaller or a tighter stop loss, then you can trade with a larger lot size. Oh, My bad. Then you can trade with a larger lot size. Your stop loss is dictated by the market. The second factor is the lot size. Your lot size should be dictated by your stop loss. Oh, stop share. There you go. There you go. Yeah, your stop loss should be dictated by the market, and your lot size should be dictated by your stop loss. Okay, and both of them, really, you want them to be kind of, you want to make the decision based on how much money you have in your account. So as a final word, one thing that I've heard most traders recommend is that you never risk more than 1% of your account. Never risk more than 1% of your account. Now, for small accounts, that's not always going to be viable. You know, it's not always going to be 1% of a £100 account is £1. Is it possible to risk £1 on a trade? I don't think so, right? So it's going to be difficult for you to do that with a small account. But if you've got, say, £1,000 in your account, 1% of that, I think it's £10. So you only want to risk £10, not per trade, but per day. Yeah, not per trade, but per trading session. So if you're going to enter 3 trades, then the stop loss on those 3 trades should not amount to more than £10. Okay. That is what I understand that a lot of them to be saying. If you have a £10,000 account, then 1% is going to take you a lot further than it is on a £100 account. But the rule of thumb is that you do not want to risk more than 1% of your account. So if you can get that mindset, just think, okay, I don't want to risk more than 1% of my account. Doesn't matter how much money you have in your account. It makes no difference, yeah? Like, you just don't want to risk too much. You don't want to risk your entire account. You don't want to risk 50% of your account on one trade. You don't want to risk 30% of your account on one trade, not if you can avoid it. And you can avoid it if you don't be greedy, if you are patient, if you respect the journey, if you take time and you manage your risk. Thanks, guys. I've been Nate the Lyricist. That is all I have to say for today. Does anyone have any? Yeah, love, bro. Does anyone have any questions on risk management while we're still here? Does anyone have any questions on the subject? Is there anything that I didn't really cover as well that you'd like to hear a bit more about?
I have a question, Nate.
Mm-hmm.
Please. Thank you so much for gifting your time. Like, you really do simplify and make a lot of things digestible. So I really, really do appreciate that, because basics really is key. You hear so much information, but when you come here, I get the basics, and it really just brings everything all together. So I really, really do appreciate it. Thank you. I do have a question, and it's, is there a formula? I know there is a formula on how you can calculate your lot sizes using your account, the size of your account with the amount of pips you're willing to, for your stop loss, which equates to the lot size you should use. I've seen it, but I can't remember.
I think there's a calculator in Shift. Is that what you're talking about?
Yeah, but instead of using the calculator, because sometimes I don't have, if there's if a signal comes through, sometimes I don't have time to use the calculator. So just having the calculation or the formula, I can just quickly put it in my calculator and be like, oh, okay, that's my lot size, and then go to my MT4.
So what was the question? A calculation that works out
there's a formula, and I wanted to know if I've seen other educators use it. Maybe I just need to go back and rewatch that particular presentation. But I know there's a formula that you can use. Who?
Javid, he does a good risk management formulas.
please, if you would it work
Yeah,
for binary as well?
yeah, it works for everything.
Okay.
Okay.
Can you?
Oh, thanks.
Yeah, if you can.
I'll have a little look and I'll see if I can find that for you.
Yeah, please. That was the
champion.
question. I hope that made sense.
It did, yeah. Thank you for that. I don't have a formula personally. I think for me, it's kind of just about getting quicker at doing the calculation. You know, like I said, I'm getting to a stage now where I'm quite quick at counting the pips. You know, as you saw earlier, I was like, okay, that's about 150 pips. Boom, that's about 20 pips. Boom, that's okay. What's that? That is 125 pips, and I'm getting quite quick at that. Right. The more you do it, the faster you'll get at doing that, and then once that's the case, then really it's just a matter of I use the okay. So if it was £1 a pip, that would be £125. If it was 10p a pip, then that would be what is that? 10 £1.25. Got that right? I think something like that. Do you know what I mean? You can kind of just do the math like that quickly. Obviously, the better you are at math, the better it is. But you can really get quick at it, and that's kind of what I'm going for. But I don't have a formula other than that, unfortunately. So yeah, thank you, Justin, for that. If you could send that over, just ping it in the group or whatever, that'd be great for me. That'd be appreciated. You're welcome, Jones. Anyone else have any other questions? Thank you, Prima, for your question, by the way. Thank you.
Thank you so much, Nate. You're making it looking more worthwhile, because I was getting so scared, or maybe kind of, is this what delving into? But you're making it more simpler anyway. I'm so grateful. I appreciate it.
I'm glad to hear that, guys. I'm glad. Okay, so my closing statement, two things that I want to say. Firstly, if I've said anything that you didn't completely understand and you're maybe a bit shy, you can always message me. Feel free to do that. Feel free. Yeah, I'm not great when it comes to Telegram, admittedly, because I'm in a load of groups and they do ping off a lot. But message me. If I see it, I'll reply to you. I do make an effort to look through, even if I'm late. Do you know what I mean? I'll try and reply and get back to you. But there is a Shiftpedia, which breaks down all the different words and tells you, okay, this is what this word means, this is what stop loss is, this is what that is, that's what that is. Literally like a dictionary for all the terminology. So if you've heard any words and you've written them down and you're like, okay, I'm not sure what this word means, go on Shift and look for it and find what the word means. The second thing to say is that while I appreciate you guys coming here, these Sunday study sessions, as I mentioned at the beginning, are my way of studying, or my way of staying consistent with my study, are my way of giving back to the Pips and Trips community for putting me on, for A, bringing me into this space, for B, educating me the way they've educated me. This is my way of giving back. I want to make sure that, for example, any people that Justin brings into this space, they don't come in, lose money, and then leave. Do you know what I mean? They're going to come in and there's a platform for them to come and study, and we can have these conversations. That's what I want to do with this space. However, if you really, really, really want to learn, okay, then the Sunday study sessions are a stepping stone. This is the beginning. This is for beginners. We're going to talk about pips and risk management again. And while what I'm going to say will be slightly different from today, because I am always learning, I'm going to be saying pretty much the same thing. Do you know what I mean? I'm going to be going around on a rota. I'm going to be talking about candlesticks. I'm going to be talking about risk management. I'm going to be talking about time frames. I'm going to be talking about, candlesticks. I'm going to talk about risk management. I'm going to be talking about time frames. I'm going to be talking about candlesticks. So we're literally just going to go on a rota, right? If you want to learn, if you want to really, 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 really learn, then what we are paying for is WOW. What we are paying for is MindHub. What we are paying for is the platform to actually have dialogue with professional traders, which I do every week, which you should do every week as well. You should be speaking to them. You should be watching their videos, interacting with them. Oh, hey, Nate, welcome back. Do you know what I mean? That kind of energy with you and some of these traders, that's the way forward, really and truly. Like if they see your name and they recognize your name and they're like, oh, okay, good, you're taking my class. It's good to see you as a regular. That's what I would recommend, that everybody here, all 9 of us in this room, should have a trader that recognizes us, that recognizes our name, that sees us, that's like, okay, boom, good to see you, welcome back. I know you've taken my class a couple of times. Even if you can't do it every single week, just know that you're paying for 4 weeks. Yeah. And then at the end of the 4 weeks, you're paying again for another 4 weeks. So if you can't do it every single week, just, make sure you're getting your money's worth. Do it 3 times in 1 week if you can. Do you know what I mean? But definitely use the platforms that you're paying for to your advantage. Other than that, guys, that is all I have to say. I'm going to continue with my day. I know there's a conference going on, so looking forward to that. And I've got a phone call that I need to call my friend back, actually, find out why I'll go on for that as well. And that is it, man. That's all I have for today. So thank you guys so much for coming through. I appreciate you. I'm grateful for every single one of you spirits that are in this room. I'm so appreciative. And I'm going to see you next Sunday at 1 o'clock.
Thank you.
Okay. Peace, everyone.
Blessings, Nate. Thank you very much for such an amazing value. We love you. And we expect you for the next better, beautiful session. We're excited to see you in the future events. Yeah. Where we're gonna do a UK tour and hopefully in a few months also an international tour. All right.
Come on, let's go. Let's go.
Yes. Yes.
The vision is there. The plan, it's about to happen. So